Good morning if you're just joining us, and of course this is the budget special this morning. We are awaiting Nirmala Sitharaman presenting her fifth union budget, and still about 3 hours to go for that. There's news coming in on State Bank of India. They've hiked their one-year lending rate by 10 basis points to 8.4%. This is, of course, something which we've seen other lenders also do, lending rates, how high will interest rates be, for how long? This is something which, of course, the economic survey pointed to as well. Important component of the macros that we discuss. We're getting you the top voices. James R. Sullivan is now joining us. He's Managing Director, Asia Pacific Equity Research at JP Morgan. Rana Gupta is also joining us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Gentlemen, great to have both of you here. Thank you very much for your time. James, if I can start with you, what are your key headline expectations from budget today?
So at a high level, we see a series of offsets. On the one hand, we do expect that a significant reduction in food, fuel, and fertilizer expenses significantly gives scope to continue to push the government's CapEx agenda. Just as an example, urea, which is a key ingredient in fertilizer, pricing is down over 50% since September. So that does give incremental room to spend. The flip side of that, obviously, is the intention to reduce the overall deficit level that's contained within the budget. So we do see these series of offsets. At base, the biggest and most important conclusion from equity markets that we do expect is a continuance of the government's CapEx push, which is positive for industrial stocks in India.
Right. James, thanks for joining in. We have Rana Gupta as well of Manulife with us. Rana, the thing is that we're heading into the budget with a very chaotic global environment. There's perhaps a recession coming. There's a large amount of FI selling in the Indian markets as well. Do you think there's a post-budget sell-off that we're looking at in both global as well as in the Indian markets?
Hi, good morning. That's always hard to say, but I do think the sell-off that you referred to in the first month of the year was more to do with China reopening. And Indian markets have outperformed over the last 1-2 years. And with China reopening, there were always some reallocation of asset to asset that would have happened, and that has happened. After the budget, I think we will be back to the global trends, and the earnings season, the way it pans out in India, we'll be back to that. But I do have to say that in the last 1 month's correction, the valuations have become a bit more reasonable in India, and China has also rallied. So last 3 months, it has outperformed quite a bit. So overall, in relative context, I think India's valuation premium has corrected. Earnings season is, I think, more or less all right. So I think overall, some of the underperformance that we have seen in last 1-2 months should actually begin to reverse.
Okay, good morning, Rana. Thanks for joining us. Aside from assuming the budget doesn't do anything good or anything too bad for the markets, do you think India is in buy zone? As you point out, the China plus and India minus theme played out, or do you think this Adani story is a fresh negative, or is it ignorable?
I think recent events that has happened is that I think beyond the group that got into all this news, beyond that you have seen pretty much correction across Indian banking, industrial names, materials names. Now, of course, that group is very important, but not so much to cause that much of correction in the banks, industrial, and material prices. In fact, those corrections are the reasons why I mentioned that the valuations are now looking attractive. Because some of those companies in banks, in materials, industrials, they reported numbers. The numbers are quite good. The only complaint we could have had is that they had run up, they had done very well, the valuations were higher. Now that has now gone. So therefore, I think those sectors are looking good, and those sectors make up for very decent part of the index. So therefore, there are quite a bit of opportunities that we see post the recent correction.
Okay. James, what is your own view on how to approach India now? There was a significant degree of outperformance that we saw last year, but do you think that's something that can continue? Are you a bit cautious now? And where does India feature on your pecking order?
So at the moment, we're overweight China, Indonesia, and Korea. We are taking a more cautious stance on India for a variety of reasons. As you said, you saw significant market outperformance over the course of last year. The Indian market's given some of that up. We've seen the performance of the Indian market, in particular relative to China, peak in November of 2022. The market has since given up gains back to, let's call it, spring of last year. So it has given up some of that outperformance. However, over the longer term, there still is significant downside relative to where the market used to trade, in particular relative to China. So it's really all eyes on the relative growth rates of China and India. China is an interesting story this year. From a JP Morgan perspective, we do believe that China will see good economic growth, but it will be consumption-led. And that has impact on commodity pricing around the region in ways that are mixed across the Indian sectors. One of the Indian subsectors that we are very excited about is the generic healthcare industry. We've seen significant price compression in markets like the United States as we went through the COVID period. Our bottoms-up analysis does indicate that the downside to generic pricing globally is starting to stabilize, which is potentially very positive for the generic subsector in India.
That's interesting. I'll pick up on that later, James, in a bit. Rana, when you say interest may come back into India after the underperformance we've seen, where will that interest show up in the most meaningful way to begin with? Is it going to be banks, which is a consensus overweight, but which is also the one sector which suffered the most in the last 3-4 days of market sell-off? What's your sense?
Yes, I think banks will certainly be a candidate because they suffered quite a bit in this correction. And we do think that correction was a bit excessive. So therefore, the banks can be one of those candidates. Also, I think in sectors like materials, particularly cement, there were fears of price competition. But I think recent events would mean that price competition may not be as severe as markets would have thought. So I think, and cement stocks corrected. So I think there's also opportunity in a cement sector. We have been bullish on industrials, and industrial stocks also did not correct that much. We continue to remain bullish on the industrial stocks as well.
Okay, Rana, just stay on. Let me get James on stocks as well. James, tech stocks, I'll come to tech in a bit. What are you advising on banking stocks now?
So banks is a key overweight. There's two concerns that we have there. Number one, it does feel like everyone's overweight Indian banks right now. We feel we were slightly early into the trade, but our measure of investor positioning indicates that it is a relatively consensus holding, particularly for most international investors. The thing we're watching closest right now is evolution on two statistics. Number one, net interest margins, where we do think there's room for positive surprise relative to current street-side forecasts. The more concerning element is as the Indian economy starts to slow as we go into the second half of 2023, we could start to see bad debt provisions starting to spike up higher than expectations, which would clearly be negative for financial stocks. And so that's something that we're watching very closely, particularly as we move into the second half of this year.
So that's an interesting point. Rana, you had mentioned that you like banks as well, but as James was pointing out, anyone and everyone is overweight on banks right now. Would that make you a bit uncomfortable? Do you think it's a bit of a crowded trade? And what is your expectation as we move along through the year?
I do think the banks are, I think many people hold this top banks. So therefore, I think within banking sector, one has to a bit more nuance to get, pick the right stocks. So for us, I think we would say that the larger cap banks, where we are most positive. And if you look at the results carefully, you will see that some of the banks, the larger banks, where the OPEX is coming under control, because the net interest margin will clearly peak in next 1 to 2 quarters. You have to look at banks where there are levers to bring the OPEX under control. Therefore, those banks can deliver EPS growth. But this is one part to it. The last time I was on your channel, I mentioned in the financial space, we also like the life insurance part. So I think that is also one segment where we are positive within financials.
Now, you also mentioned materials. So you would be buying material stocks now?
Materials largely refer to cement because I think cement stocks suffered correction, and now I think there's an opportunity to look at those stocks again.
Ambuja in particular, Rana, if you can name names?
I won't be able to discuss stock names.
Okay, no problem. James, what is your view on the sort of Adani Group stocks and any potential lingering impact on markets overall? Your sense?
We've published significantly on the range of information that's available in the marketplace today and had very significant client interactions off the back of this issue. I think the key thing that we would focus on is the very basic issue of transparency. The more information investors have at their disposal, the better decisions they'll be able to make. And that's positive for equity markets, not only in India, but globally.
Okay, James, appreciate your thoughts. Thanks a lot for joining us on CNBC TV 18. And Rana, before we let you go, anything specifically from the budget in terms of individual sectors that you're looking at? I mean, a lot has been done in infrastructure, defense, renewable energy. There is some talk of tinkering of the tobacco tax as well. What would your key preferences be sectorally?
Actually, there are no sectoral preferences that we have or expectations that we have going to the budget. I think budget, I'll just say two very quick things. The budget, and if you look at not just this budget, look at last 4 or 5 budgets. Budgets have become more of a transparent, credible, and simple exercise, which we absolutely welcome. And the quality of revenue is improving because the tax collections are doing better in spite of tax rates being stable. So that's very welcome. And the quality of expenditure have been improving. Less of revenue expenditure growth, more of capex growth. So we expect the similar trends to continue. This has implication not just today, but longer term for 2 sectors. As the domestic savings grows, it bodes well for the domestic financial sector. And as capex grows and the domestic savings grows, that also bodes well for the private capex, i.e. the industrial sectors in the stock market. But that's just not for today. That's for medium to longer term view.
Okay.
All right, Rana, thank you very much for your time. Great speaking with you.
Thank you.
James, appreciate you joining in with that perspective as well. Appreciate it. Well, as we slip into a quick break here, here's a quick note that we have a star panel lined up for you immediately after the